Welcome everyone, I'm Pace Ellsworth, and today I'm just going to go over how does this early retirement calculator work. Very basically, we've simplified it to these just three variables at the top: your current age, your monthly income, your savings rate. In the future we're going to add more variables, but for now this is what it is, and it's going to be for a flat 20 years. That's pretty flexible for most people to save from young age for 20 years or from age 30 or 40. Obviously for age 55, that's a little bit long to retire, but it's pretty common nowadays. We'll be adding additional features for that in the future. So that's all you have to do. It's going to automatically calculate. You don't have to press any buttons, and it will fill up this chart right here. And this chart is going to output four values. What you would get in outside of a Heleum account if you did as well as 10% per year after fees, which is very similar to what you would get if you invested your IRA or 401k into the S&P 500 over the long term. Okay, so that's what you would get if every year was the same. So it's somewhat unrealistic, of course. This is just hypothetical. But as you could see, you could really only save up about $687,000 in an IRA. Now, in the Heleum accounts, there's a special feature where our partner is actually going to help you invest in your account. They're going to match the funds that you put into your account. This supercharges the returns and overcomes all of the fees associated with the life insurance. Now, the life insurance is good to have in there because just in case you pass away or for long-term care or any other illness needs, you have something that's going to take care of you even if you don't have that money saved up. That's the purpose of the life insurance. And the other benefit of the life insurance is even in down years, your account actually doesn't go down, and you can borrow out against most of the cash value in your policy, in your account, at any time. So again, this is an indexed universal life policy. All right, so this also compares against the Heleum account earning at 6%, which is a conservative estimate. When you meet with the financial advisor, they'll show you more official numbers that look like this. Just by law, they're required to be very, very low and conservative. But realistically, the actual returns in these accounts is 8%, 10%, up to 11% historically on average. That's just the way that the look back in the types of crediting is working today. And those aren't invested in any specific fund in the market. It's a mix of funds and also custom notes and corporate bonds and things like that. So what this down here is just the word description of the process. So if you save this amount per month, which is the total monthly income times the percent savings rate, okay, for 20 years, growing at this percent per year, the Heleum's partners will lend you up to a 5x match. Sometimes it can be higher. For 20 years at only a 4% interest. This will fluctuate. With some providers it's under 4%. With some providers it's up to 5%, sometimes higher. But our partner, it's contractually maximized. Maximum is 4.75%. So, and then they'll grow in your account 6 to 10%. With our partner, it's 10% or 11% per year on average. Now, even in down years, it could be 0%, but in up years, it could be 12, 15, 20%. Okay, and then depending on those market returns, if you get that average 6 to 10% per year, you'd be saving up over 20 years a cash value or an account value of $1.5 to $2.3 million, and that's with just putting aside $1,000 per month. Now, that might be a lot. That might be a lot for you right now. The way these can actually get set up is you can actually put a majority of your income in and then pull a majority of your income out in loans. And you don't have to pay those loans off until you pass away. You never have to pay them off up to certain limits. But if you were to compare this to a 401k, you would only have up to like $680,000 in that account because you don't have that internal arbitrage, that leverage happening. So then the last thing to do would be to book an appointment. In here, you would just specify some additional questions that can help us understand how we could help you more. So for example, if you have a large lump sum to put in to these accounts, it's actually very, very beneficial, and you can start getting that leverage a lot earlier, like year 2 instead of year 3 or 4 or 5. If you're planning on moving soon, or you have a lot of equity in your property, then just say yes. If you're a business owner, a small business owner where you have just yourself as an employee, or you have more, even if it's just yourself, just say yes. And what this will tell us is that there's an opportunity where you can offer this to your company as an alternative to a 401k and get significant additional benefits out of it that way. And you can actually use the cash flow in your business to help accelerate your early retirement account. Just put in your phone so we can confirm your appointment with you if we need to move your appointment for any reason. Tell us which state you're in and when you want to have that appointment. If these get double booked, we will contact you and move them around. No worries, but everything is automatic. So yeah, just feel free. Nothing here is set in stone. You're going to go through these numbers more officially with an actual licensed financial advisor. And yeah, we're here to just get you some more information. This is all based on numbers that we pulled from an official illustration from a life insurance contract. This is hypothetical. This is a complete hypothetical numbers. It's just to give you an idea of what could happen, but your individual situation, you'll have a custom fit retirement plan made for you by a retirement advisor. So let's see.